Hello, and thank you for tuning in today to Issues of Interest from Baker Newman Noyes, where we cover assurance, tax, business advisory, and technology topics and trends affecting the banking and financial services industry. I'm Joe Jalbert, and I lead the banking and financial services practice here at BNN. Banks and financial institutions are constantly navigating volatility and change. Here at Issues of Interest, we help you stay current on what's happening in the industry so you can achieve success for your institution. Now, let's get into the episode.
Hello, everyone, and thanks for joining us for Issues of Interest, BNN's podcast for the banking and financial services industry. I'm your host yet again today, Adam McCoy, a tax principal here at Baker Newman Noyes and a member of the firm's banking and financial institution practice. I'm here today with Connor Smart, our tax manager at BNN. Hello, Connor.
Hi, Adam. Thank you and good morning. Happy to be here.
Thank you. Before we dive in, Connor, can you just give our listeners a background about your role at BNN and what you focus on?
Yeah, absolutely. So I started with Baker back in 2016. That's where I started my career as a CPA. And these days I work predominantly in two areas of tax practice. One is tax compliance and consulting for nonprofits and exempt organizations. And then the other being specific to unique compensation and benefit plans. So whether it's issues of retirement, tax implications of various retirement plans, equity compensation, and strange alternative compensation plans or structures or ideas. I help provide some compliance advice on how to navigate these kind of archaic and muddy waters of the tax world for how these odd compensation arrangements can go.
Right. So your focus isn't necessarily specifically in banking. You help our department as a whole, but there's a lot of overlap that we see. I don't know how many times a week I feel like I'm sending you some type of employee benefits question or deferred comp question. That team is extremely important for us to all be able to do our jobs and function as a team. And you definitely do a lot there. And then we have a number of banks with foundations and stuff. So the nonprofit world overlaps a lot, actually. So I think we end up emailing and corresponding a little bit more than you might think otherwise. So.
Yeah, it's definitely something I enjoy doing because of that overlap in so many different departments. I mean, the comp and benefit stuff especially, it's very broad, right? It's not just banks and corporate entities, but it can be sole proprietors, it can be partnership. A lot of these odd structures or alternative or confusing structures for how you can set up different plans and arrangements can really hit anyone, any kind of taxpayer or any industry. It has a wide applicability across different tax types and industry types.
Yeah, completely agree. And we see that all the time. So today, I think we were just trying to hit Section 409A and just some high level things in that area and try to focus in on one topic where there's so many other topics we could hit. But this is a big deal and the penalties can be quite onerous on people too if they miss something along the way. But just to kind of backstep a little bit, can you just explain a little bit about what 409A, that section is and why it is such a big deal?
Yeah, absolutely. I think that's a great place to start. So I'm going to get a little bit tax technical just to start, and then I'll step back from it. And what I mean by that is I think a good place to start is to just read what the section's called and its initial definition, and then I'll step back and kind of work through it to explain the different phrases and words for what that means. So Internal Revenue Code 409A is the section dealing with inclusion in gross income of deferred compensation under non-qualified deferred compensation plans. What it is basically saying is under what conditions, if you have what is deemed to be a non-qualified deferred compensation plan, when can those benefits fall back to you being the person participating in the plan, the person deferring their income, and what are the penalties involved if the plan fails to maintain eligibility under 409A? And alternatively, how do you keep your plan compliant with this? So that means how are you able to defer compensation under any sort of plan and not have it be taxable income to you and have it not incur penalties? So one of the key words right at the very beginning is this idea of a non-qualified deferred compensation plan, which is a very long title that has a very broad definition. So a non-qualified deferred compensation plan is any plan that allows for the deferral of income other than a qualified employer plan or a bona fide vacation sick or disability or death benefit plan. That second bucket, your vacation and sick leave category, that's probably self-explanatory. And then a qualified employer plan would be your things like 401ks, right? These are tax advantaged retirement plans. So that's a very large bucket, right? Now to just step back, because that's what we're talking about. And then what that means is any sort of plan that allows you to kick out or defer income recognition to a future period, anything that's not a qualified plan, such as a 401k as a common example, or a sick and disability type plan. So that can count to a lot of things. That can be deferred bonus pool plans. That can be severance arrangements. In certain instances, that might even involve complicated equity compensation arrangements. It can get really complicated and it's very broad. And the reason it all matters is because say you fail to comply with Regulation 409A, the consequences and penalties are very severe. Failure to comply with 409A means that 100% of the deferred income becomes immediately taxable to the plan participant, which is important because even if the failure is a result of, say, the employer managing the plan, maybe they mess it up. It doesn't matter from the tax consequences. It all falls to the participant. Second penalty on it is that there is a 20% excise tax penalty included on the gross income that was deferred and is now recognized. So you not only have immediate recognition of all of this income that you thought you were going to defer out for who knows how many years. So that's all taxable immediately. Then you have 20% of that. And then lastly, you have interest accrued on it. And the interest is equal to the underpayment rate plus 1%. And it is accrued as of the date it was first deferred or not subject to substantial risk of forfeiture. In other words, as of the date it was deferred or vested. So you have those three tranches of potential penalties and costs should you fail to comply with 409A. You have immediate income recognition. You had the 20% tax on top of it, plus whatever the ordinary taxes that you would pay anyways to just acknowledge it. And then you have interest accrued on that balance as of who knows how many years ago from whenever you started deferring. So the consequences get very severe very quickly.
Right. And that doesn't even really take into account that if you're immediately recognizing some of that income that you're meant to defer another 10 years, like the cost of time value of money there comes into play too. And that's not necessarily even calculated in those percentages. So, what you're paying tax on today and not being able to build up could really add to those costs and penalties and things that you were paying along the way.
Yeah, absolutely. The cost and impact that it can have on your future tax and wealth planning, really, and what your expectations for retirement horizons, personal life transition horizons can be completely upended for failure to comply with a 409A plan requirements.
Right. So kind of staying on that topic then, what are some things you might think about in terms of trying to stay compliant? Like what would you do to be compliant with these type of rules?
So what's fortunate about 409A is that as far as an Internal Revenue Code section goes, it's not terribly long. So even though its application is extremely broad and it's always applied on a case-by-case basis, and the penalties are severe for failure to comply, actually the steps themselves for keeping a plan compliant with it are relatively straightforward. The first step is that when you are first setting up an alternative non-qualified deferred compensation plan, you want to make sure that you're aware of 409A from the beginning. So if you're setting up any multi-year severance agreement, deferred bonus pool arrangement, something like that, be aware of 409A from the start and draft your plan document and plan agreements for the deferral arrangements in accordance with 409A. If you can get things set up from the beginning and you understand the requirements, that'll help a lot. If the plan document is written in compliance with 409A, you're much less likely to have a trip up and failure later. Now, I don't want to get into every single caveat of 409A, but I think the most important thing for being compliant and where the biggest issues seem to occur is the idea of people taking funds out of the plans. So there are 6 general categories for when distributions can be taken out of a non-qualified deferred compensation plan without violating 409A. But again, it's important to highlight that these must also be in accordance with the plan document, which itself must be in compliance with 409A. Now, I'll explain what that means in a second. So those 6 conditions where you can take distributions are separation of service as determined by the secretary and in accordance with the plan documents, the date the plan participant becomes disabled, the date the plan participant dies, in which case the funds can be taken out for whoever the noted beneficiaries are. The most common is a specified time or pursuant to a fixed schedule under the plan at the date of such deferral. So what that means is you set up a plan and it says 10 years hence you can start taking out distributions, and you'll take a distribution every year for X dollars or something along those lines. That would be a common example, something you might see, for example, in a deferred bonus arrangement. It can be possible to start taking distributions due to a change in ownership or control of the underlying employer, or in the case, lastly, of an unforeseen emergency. So that last one is the most gray and ambiguous category. It needs to be very, very clearly defined in your plan document what an unforeseeable emergency means for purposes of being able to take distributions for 409A. So I would recommend reviewing that section and the underlying code to make sure that it's a bona fide emergency that would qualify for distributions. I had said previously I'd define what it means to take these distributions in compliance with your plan document. The plan document might be very specific and might not, for example, allow distributions from the deferred plan upon a change in control. So what that means is that if you later do have a change in control, but such distributions are not allowed in your original plan document, it might mean that there could be some 409A issues there, because if the plan document doesn't allow it, but then you're starting to take funds out, perhaps superseding a future specified time arrangement, you might be tripping up on that requirement. You have to comply with the plan document, which must itself comply with 409A. So those are the core distribution requirements for when you can take funds out. And that's where I see the biggest issues for 409A frequently come up, or people trying to do what is called accelerating benefits. Basically, they're trying to take money out of the plan sooner than would be allowed under the original plan document and agreement. Acceleration of benefits, changing the plan or taking distributions out of the plan too early, basically poses a high risk of exposure to plan failure and then having all those income recognition issues that we talked about before.
Right. I think it's probably pretty obvious to anybody listening now at this point, these rules get pretty deep and technical pretty quickly. I mean, you're even going over extremely high level, in each fact and bonus pool that we tend to see is often a little bit different, and the facts and circumstances matter in every single case. So just piggybacking off that, how often do you see these type of issues come up, and do you have any real life applications or examples where you've seen some of these problems come up in the past?
Yeah, so they do come up with a certain level of frequency, but luckily a lot of the times they seem to come up where people are aware that these rules are floating out there. Maybe they were reviewing the plan document and saw reference to 409A in it, and then thought to reach out to say, hey, what does this section mean where it says our plan document intends to be compliant with 409A on distributions, but they're not quite sure what that means. And so a client might reach out to ask, hey, we want to start taking distributions out of this plan, but we don't quite understand what this caveat is referencing. Can you explain? And that helps us head off some problems. So and luckily, that's kind of what we see. And that's the best case scenario, because then you can opine on it and say whether they can or can't do some sort of transaction with the plan that might trigger these penalties. So a common real world example that I've seen a number of times is you have some sort of multi-year severance agreement. The severance plan allowed the participant to defer income, or the employer made contributions to a deferred plan over multiple years. And the idea was that after X number of years of service, they could start taking annual distributions from the plan, or upon retirement, once they fully vested in the benefits and they were ceasing service with the organization. What I've seen happen is that organizations reach that point, or they're getting close to that point, where this person wants to retire and start drawing from their severance. And they say, this person, they're not going to do anything more for us. They've done all their work. The benefits have vested. Can't we just pay everything in one lump sum and just close out the plan? We don't really want to manage it anymore. We don't want to track it. No one else has this kind of arrangement. Maybe it's an old grandfathered plan that's become a bit of a pain or a hassle to administer. That is a common example which would constitute an acceleration of benefits, because the original plan said, hey, once you start taking distributions, they have to go over this fixed payment period over multiple years. So by you paying it out as a lump sum to just close out the balance, you've now violated 409A, which means that entire balance in the deferred severance plan is going to be taxable to this individual immediately, plus those penalties and interests. And so that's an important caveat too, because the organization might go to this person and propose this kind of payment scheme, and this individual might not be aware of the implications of 409A, but they're the ones who have to carry the burden of the costs, the penalties. That's all borne by them as the individual, not the organization. And if the organization holding the plan is being compliant, they actually have to report that on their W-2. There's a specific code for it that would notify the IRS, and that would then trigger them to look for that penalty and interest on it.
Thanks for that summary, Connor. I think this all just kind of goes into the whole, if you think there's any issue or you think there could be any issues, we got to look at this ahead of time and try to stay up on it. Don't want to really mess with 409A. I think, as our colleague here, Drew Cheney, has always told me when I've talked about him in the past too, is the penalties are draconian. You have to really stay on top of it and make sure your plans are compliant. And that usually involves a combination of your accountants, your legal team, your HR team, and everybody kind of talking to each other. That's usually the best course of action, is everybody in that team is together and talking, and we can all point out things and move along at that point too. Only other thing, just real quick to bring up, because it comes up a few different times, and sometimes it's a tax planning opportunity, is just within the plan too, there's a kind of a special timing rule when it comes to the FICA taxes on the deferred compensation. We see this a lot with our deferred bonus pools and things like that. Just if you could hit briefly maybe on the timing rule when it comes to FICA investing.
Yeah, absolutely. That's a good question, because it's confusing and it does come out quite a bit. So not only do you have all these structural implications of non-qualified retirement plans, or compensation plans rather, in regards to 409A and having these penalties and things, but just in regards to payroll taxes, things can get a little bit wonky. So under the special timing rule, amounts deferred under a non-qualified deferred comp plan, they're subject to FICA tax on a different timing than your federal income tax would be. So not only does this get a little bit weird in terms of when you pick up the income, but it also has implications for the employer as to when do I actually need to report this on the W-2. It impacts your payroll returns and your withholding requirements. So FICA tax is actually due on the non-qualified deferred comp plans at the later of when the services are performed related to the actual deferred amounts, or two, when there's actually no substantial risk of forfeiture of such amount, which basically means when they vest. So to repeat that, FICA tax is due at the later of when you perform the services related to the deferral amount, or when they're vested. That differs from your federal income tax recognition, which might not get picked up until you take distributions, which could be years down the road. So you'll end up with instances where your base income that's subject to FICA taxes is not going to be the same as your income tax. And then that will flip-flop later. So for example, when you take those distributions out later, those amounts previously deferred and subject to FICA don't get taxed again. They get taxed once, and then that's it throughout the lifetime of those deferrals for purposes of FICA taxes. It's your income taxes that will be recognized later, potentially, depending on the plan, of course. I don't want to say a golden rule for these because everything's facts and circumstances specific. But I think the takeaway is to just know with these plans that the timing for these different tranches of taxes that will be recognized on the income is not going to be the same for each type of tax. It's going to vary, and that will be relative to the plan itself, its vesting schedule, and when and how things are being deferred.
Right. Yeah. Definitely not a one size fits all necessarily approach with these things because you're right. Very fact and circumstance dependent. Planning opportunity sometimes comes into play too, where you might vest in a year that your income is already over the Social Security limit. So you might invest and you might be able to save those Social Security taxes because you're already up above the limit for the year. So sometimes that comes into play. I mean, there's always the timing and time value money considerations as well. But it's a good point and good thing to think about because it does come up quite a bit.
Yeah, absolutely. And it also, because it's that FICA tax applies when you have the initial vesting, if those amounts later increase in value post deferral, you don't get hit on that FICA tax again. So to your point, if you're already above those limits, at that point, you've already gone above and beyond. So you have savings on that point. But then you also don't get hit on the earnings again later when you're taking the distributions. So there could be potential tax plannings there, assuming, of course, that there are earnings on the deferred amounts.
Right. Of course. So I think the takeaway I took away from that is just take a look at your plan and see when you're actually including the FICA vest, if you're including at the date of vesting right now or not, and what your options might be if you're not or if you are, and just make sure you're planning accordingly. But with that, actually, I think we've covered quite a bit in a short amount of time. There's a lot to this topic and a lot more than we covered today. But it was great to chat with you today, Connor. And any other takeaways or anything else you want listeners to walk away with before we head out?
I think if I could just highlight and recap a couple core things. One is just to remind listeners that 409A applies to many different deferred comp arrangements. So always look at your underlying plan. Just be aware that 409A might apply. Be aware that the penalties and consequences of failure to comply with 409A are very severe. So it's important to review the plan to see if it's subject to it and to reach out to your tax advisor to make sure that the plan's being compliant. And to that last point, because it's so facts and circumstances specific as to when money can be pulled out of the plan, the cost of reaching out to just ask if it's okay to take distributions and be compliant with 409A may be far less than having to deal with a plan failure. So I would just advise and echo on your point, consult your tax advisor, reach out to us if you have questions on if there's problems with a plan or if it's eligible to start taking distributions. But otherwise, I agree that 409A is very technical and gets really into facts and circumstances specific guidance. But hopefully this conversation has been helpful, and I really appreciate you taking the time to speak with me today.
Thanks again, Connor, and kind of a whirlwind and a lot of information at once. And I don't know, not quite 5 o'clock yet, but maybe we should go grab a drink and try to calm down after that too. Again, thanks for listening in. And just to let listeners know, as always, we're monitoring and trying to share updates and development as they come along. Stay tuned for more articles, podcasts, and resources from our team. Goodbye.
Thank you for listening to Issues of Interest from Baker Newman Noyes. The B&N banking team thrives on solving complex business challenges and helping institutions meet their goals. You can find more of our industry content and subscribe to our newsletter at bnncpa.com. If you'd like to connect with a member of our team, email info@bnncpa.com. Bye now.
This podcast is brought to you by Baker Newman Noyes. The information contained in this episode is based on data available as of the date of its release. BNN is under no obligation to update this information as changes occur. BNN podcasts, events, and publications are intended to provide general information to our clients and friends. It does not constitute accounting, tax, or legal advice, nor is it intended to convey a thorough treatment of the subject matter. The information in this podcast may or may not apply to your individual situation. Consult a professional for help applying these concepts to your personal circumstances. Please contact Baker Newman Noyes for additional assistance at info@bnncpa.com. More information can be found online at bnncpa.com.